Hey, Home Care Ops Nation, this is Kevin Hansen with Home Care Ops. I'm here today with Bill Stansbury. What we're trying to do is fill up this Home Care Ops Nation catalog and library with great information from resource partners that come from different expertise areas in the home care industry. Bill works with Succentrix. Succentrix Business Advisors. They work with home care agencies throughout the country on accounting best practices and helping them really figure out their bookkeeping. Bill, how long have you been working with home care owners specifically? I know you've probably done a lot of bookkeeping and accounting for a while, but how long have you been working with home care owners?
Yeah, thanks, Kevin, first for allowing me to come on and talk to you. I appreciate the opportunity. Well, actually, it starts back when I first graduated college. I was actually in healthcare operations at the time. I was a nursing home administrator back in the day, so I got my feet wet in healthcare. And one of the doctors that I was working for told me I didn't need to quit my day job, so I went to school and finished my accounting and decided to go in business for myself, and started off working as a controller and CFOs for hospitals and home health and nursing homes, things like that, and then decided to go in business for myself. And I've actually been working with home care businesses for about 5 years now, using the expertise that I have from operations and bringing it to the accounting side.
Awesome. So we should be able to cover quite a bit here. So our challenge now won't be covering it. It'll be covering it in the 15, 20 minutes we're trying to hold to, right?
That's right. That's right.
Perfect.
We got it all covered.
Perfect. All right. So we do a lot of master classes. We do a lot of webinars and trainings, and repeatedly at some point, either Clint or I will talk about how if you measure it, you can grow it. And a lot of times we talk about operations, but it very much applies to money, right? So when it comes to bookkeeping and a home care owner setting themselves up for success, what are some of those key metrics? People call them KPIs sometimes that they should be measuring, right? And how do they ensure that they're measuring those correctly?
Well, number one, you nailed it. Bookkeeping is the foundation of our financials. If we don't put numbers in the right place, we can't know where you are, and we can't measure have the correct measurement for that. So number one, we need to make sure all your transactions are classified correctly and go in the right place. And talking about that, we need to know the difference between cost of services and your regular monthly fixed and variable expenses. So your cost of services, those are things like your home care. Um,
The
well, I just
caregivers
lost the
and the
word.
aides?
Your caregivers and aides are your cost of service payroll that you're going to be measuring, and then everything that works with the increase or decrease in revenue. If it decreases or increases with revenue, it's pretty much a cost of service. So what we do is we want to take your revenue, and we want to make sure that we're measuring it based on what you billed for that month. So in your bookkeeping, we're going to keep up what you deposited, but when we report and look at it, we're going to look at actually what you billed for the month. Same thing goes for caregivers. In your bookkeeping, what you're going to file for your taxes is going to be different from what we're going to actually measure. So you're going to look at your caregiver payroll. We're going to pull it from your billing scheduling software. So for every hour that you've billed for, we're going to actually get a payroll dollar for that hour. So we get a good caregiver to gross revenue number. And we know in the home care industry, for most parts of the country, that ratio needs to be about 50%. So if we're not at 50% on caregiver ratio to gross revenue, then we need to look and see if we need to make any adjustments there.
So which is worse, to be over or under that 50%?
Yeah, over that 50% makes you worse because you're spending more caregiver dollars per dollar of revenue that you're getting. So what we look at is if you're getting over that 50%, number one, we want to see what part of the country you're in, because we have different states in the United States that uh, payroll is just naturally higher. But we know those, so we know how to account for that. But if you're starting to go over that 50% mark, we need to look and see, do you have a lot of overtime? Um, are we having the extra scheduled hours for we're not billing for? Or the biggest thing that I found in the last 3 or 4 years that we're not charging enough for our services. So that's probably, after I've looked at overtime, that's probably the next thing that I ask is what are you charging? Because your caregiver payroll needs to be about 50% for it. So for every hour that you're billing for, that caregiver payroll needs to be 50% of that. So we look at those charges, and I've had, probably over the last 3 or 4 years, 10 or 12 home care businesses that has increased their charges and got that ratio back in line.
So if they're less than 50%, they're good. If they're over 50%, that's the time when you have these home care owners coming to you and they're saying, Bill, I made $100,000 more in revenue. Why am I showing red in the books now? Like, right? Because they didn't have that correct with the P&L. They're losing money, even though they're making more money over the revenue and sales. They're losing money through operations, right?
Well, exactly, because as you grow and you move through the years, inflation requires you to increase your payroll. You have to keep up with the market and what you're paying your caregiver. So as you increase their pay, you need to be increasing your charges at the same rate, or else you're losing money.
Yeah, awesome. Now, looking at all those things, profit loss margins and some other metrics, how often do you recommend the home care owners take a step back, review the numbers, and which reports specifically would you recommend they pull at this regular increment?
So we're just going right down the line of what's important for these, not just home care operators, but businesses in general. The number one thing that I see people doing all the time is they're basing their business by how much money they have in their checking account. So instead of pulling any kind of financials from their accounting software, they're just going to their bank account every day and make sure they have money in the bank, and that tells them that they're doing well. But that's not the way that we should be doing business. We should number one, our bookkeeping should be right. We're putting things in the right place. But then number two, we should be looking at our financials on a monthly basis to make sure we're actually profitable. And by saying that, mostly we're looking at the P&L each month, the profit and loss statement. So we want to pull the profit and loss statement, look at those things and compare them to our industry KPIs or our industry standards to make sure that we're in line with those things. Number one, like we just talked about, we want to look at cost of services versus gross revenue. And once we decide that our gross profit margin is good, then we start looking at what's below that. So, if we're not showing a profit at the bottom of the profit and loss statement, but we are in a good gross profit margin, then there's something that's skewed within the rest of it, within our regular monthly expenses. So then we can go down and compare those things to industry standards, see what's too high. For instance, you might be looking at maybe office staff payroll may be high, have a high KPI compared to what your industry says. Well, we look at that and we say, okay, let's look at that number. What, just by you looking at that number, is better than probably 50% or 60% of business owners, because they're not even looking at those things. But you looking at that allows you to make some decisions. So now we can look at it and say, okay, we're high, but we're growing by this much each month. So we know in 3 to 6 months, we're going to cover this payroll. So we're good with that. We're going to stay right there. Or we say, no, we're not good with that. Let's make an adjustment. We need to bring it down so we are in a profitability state. So I've seen, especially during COVID, we had such a down drop because we had home care operators that couldn't go into places to see patients anymore, to get referrals. We had a drop in revenue with a lot of them, but they didn't make changes within their office staff to compensate. So we saw that a lot during COVID. So we had to talk to owners. We know we didn't, necessarily want to lay people off, but we had to think about how long is it going to take us to recover from this? And can we continue to sustain this type of expense through this time? So we had to make some hard decisions through that time with some of our owners, whether we needed to cut staff here and there to get back profitable, because, where's the money coming from if you're not profitable, right out of the operator's pocket to take care of it. So we've actually seen these things, and if they weren't looking at their financials every month, they wouldn't understand where they were losing that money and wouldn't know what to do. So that's very important to look at your,
So that stuff that would
every
get away
month.
from them really quickly then, right?
Yeah, that's right.
So
If you're not looking
so
at it on a monthly basis.
watching the trends monthly, and then doing a more deep analysis quarterly, probably, to really look at where some big decisions need to be made, right? Because if it happens in a month, that's one thing. If it happens 2 or 3 months, then you've
Yeah,
got a serious issue.
that's right. And what we do is we look at a monthly P&L, and we look at an annual P&L in this at the same time, and we look at where you are specifically for that month on your KPIs, and where it shows you're trending, if you look at the annual. So then we can see if you're moving in the right direction. But if you don't have your KPIs or your goals set, you don't know where you're going to. So you need to have those planning things, at least annually, to plan where you want to go for that next year, so you have something to compare to.
You do some good forecasting, some planning, and that would, I mean, the more you track that, the better you can set some realistic goals as well too, and make those adjustments necessary. Speaking of
Well,
adjustments,
and I was going to say, in the same way, Kevin, sorry to interrupt you,
you're
but
good.
looking at your numbers on a monthly basis also knows how you're tracking in your revenue. So if your revenue, if you're out there marketing and you're gaining clients and your revenue is steady going up, if you're looking at those numbers every month, you can see, okay, I need to make a plan to hire somebody, in the next 3 months, because if I don't do that, I'm not scaling myself well. We're going to be overloaded with too much in my office, and we're not going to be able to take care of the clients like we need to if I don't do that. So it also allows you in planning by looking at those numbers every month.
Perfect. So with all this tracking, measuring, and analysis, there's another sneaky thing that comes in once a year. And I know when I owned a couple small businesses ages ago, that annual time coming in and reporting taxes kind of surprised me, right? So throughout the year, even if you're measuring or not, even if you're looking at your P&Ls or not, there still comes this answering to the government as far as your profits or your losses, and how that looks at the end of the year. Even with losses, some home care owners surprise themselves and they still have to pay taxes. With profits, they definitely have to pay taxes still, either way, right? But I had a business that had a loss for its first year on the books, and I still paid taxes. I didn't plan right. So
Yeah.
looking at home care owners now, what are some common areas that you see that really help home care owners avoid, maybe not paying taxes, but avoid a surprise when it comes to tax season?
Well, when I do a webinar or a little talk for people, one of the first things that I ask is, everybody raise your hands if you pay your fair share of taxes. And so nobody ever raises their hand, because everybody thinks they pay too much in taxes. So
Yeah.
that always shows me, number one, the biggest thing is we're not planning for it. Just like you said, if you're looking at your numbers every month and you're seeing a profit at the bottom of that, at the end of the year you're gonna owe some taxes. And the difference between a business owner and a W-2 employee is a W-2 employee is having that tax withheld from their check every month and automatically getting sent to the government, to the IRS, to cover potentially what they're going to owe.
Mm-hmm.
And by the way, the IRS wants to have that money frequently. They don't want you to wait to the end of the year. They say you owe that money as you make it. So that's why we say, if you're showing a profit during the year, you want to file your estimated quarterly payments. Let's just make an estimate of what we think that you'll owe. And then if you estimate it correctly, then at the end of the year, number one, you don't have that big tax bill at the end of the year that you owe, that you wondered, why do I owe this much money? Number two, you won't have penalties and fees that are tacked onto that, because the IRS is going to put fees and penalties on it if you're not paying quarterly, because they say, just like I said a few minutes ago, you owe that money as you get paid. You don't owe it on April 15th. You owe it as you get paid. So they want to see those quarterly payments every month. And to talk about tax, not only do we want to do business planning as far as looking at your profitability and hiring accordingly. But we want to do tax planning as well. And a lot of accountants tax planning, all it involves is, coming to me, November, December. Oh no, we've made, $50,000 profit this year. Well, you need to go buy something so we can depreciate it and try to get that tax bill down some. Well, I believe we should be planning all year long for those tax moments, for those things. And the number one thing is your entity selection. That if you're working as a partnership or an S corporation or C corporation, those entities are taxed differently. So you need to know there's different tax planning procedures, strategies that you can use for each one of those. Also, you have other things like accountable plans. I have owners that are making really good money in home care, so they want to do something to help save them in taxes, but also help
Mm-hmm.
them own assets. So I say, well, let's think about buying. If you're renting your office space, let's think about purchasing office space and renting from yourself. And then you have the
Yep.
depreciation, and we also have accelerated appreciation on commercial real estate. You have all those things we can look at that helps you um, reduce your taxes.
Additional lines of revenue that get generated just by better tax planning, right?
That's correct. That's correct.
So,
And then of
and
course
this
you need to
and
make
this
sure
doesn't
you file
matter.
your. Go ahead.
This doesn't matter really based on the legal entity, because I mean, there's differences in how you report taxes and you report your structure with that legal entity, LLC, S corp, or not. Either way, you're going to have some taxes to file throughout the year and pay throughout the year. And frankly, when you look at P&L, if I'm holding my tax money until the end of the year, I might be really surprised on what my real P&L was, because I'm holding my tax dollars owed as part of what I show as money on the books for me, but it's really something that should have been getting paid out at part of the loss side of things for the taxes, right?
Well, it's not going to show like an expense to you, but as a cash flow issue for
Yeah,
you.
cash flow. Excuse me.
So
That's what I meant. Thank you. That's why you're
yeah,
here.
yeah,
Correct me on that.
and cash flow is king now. I mean, I believe in the P&L and making sure you're profitable. But if you don't have the cash, I mean that, or you spent your cash before you get to your taxes, then you have a cash flow issue, and you don't want to have a cash flow issue with the IRS.
Yeah,
But I want to go
they're not
back
very
for just
forgiving,
a,
are they?
no, definitely not. I want to go back to a thing that you said a second ago, because entity selection can be a very useful tool in reducing your taxes as well. So because like in the beginning, when you have a startup company, I usually let's just start up and file our company as a partnership or disregarded entity. And because if you most small businesses show a loss the first year, and so a partnership is the best entity to be in to show a loss and be able to count your losses with the IRS. But when you
Mhm.
start making money, there's a certain point where we need to consider the S corp election with your partnership, because now you can avoid paying some of the self-employment taxes that you were paying as a partnership or sole proprietorship in the S corp election, and that saves you money. And it also has some other things that you can do in S corps that are helpful. Now,
It
one
sounds
thing
like
that I
a
would.
whole sounds like a whole large topic, maybe to cover in an article someday, right?
Yeah, so we can really get to that. And this next one is going to be a really good one that we probably could do a whole separate thing on, is a C corporation.
Hmm.
Because a lot of your franchise owners these days and business owners, they're coming out of like a corporate job, and they want to go in business for themselves, and they're taking their 401k, and they're rolling it over into what we call a Rob's account, and using their
Hmm.
401k as an investment in their company. So, and to do that, they're required to form a C corporation in order to do that. And the C corporation, the reason why most small business owners stay away from C corporations is because they talk about this double taxation. Because C corps get taxed just like an individual, and then you pay yourself and you get taxed too. So there's different strategies with a C corporation, and a lot of people don't know what to do about that double taxation issue. So that's another one of these things that we have to plan ahead for.
Again, paying more than that fair tax. So with the home care owners now, like just looking at some of the newer ones, maybe they're at a certain stage in their business where they're trying to scale up, what resources are available to them that they can use on their own that can help tie things together, integrate things better together? And as you decide to scale up and take on an advisor or a consultant or a CPA, outside and outsourcing that, what are some things they could do now to set themselves up for more success, not just in the moment, but especially when they scale up and bring someone like you on or another accountant on? What are some of those tools and resources available to them right now?
Well, let's start with this, Kevin. Let's say, number one, the business owner did not go into business to do accounting.
Mm-hmm.
They didn't go into home care business to sit behind the computer and do their bookkeeping. They did it because they wanted to help people, want to take care of the elderly. That's what that's what their goal was when they went into business. So I think the quicker that they can transition from them doing that work to a professional doing it, the better off they are. I always tell my clients, if you ever think that I'm costing you money, then you need to find somebody else to do the work for you, because I should be either saving you money or making you feel like you made a good investment, because I'm going to be doing the work of a bookkeeper, a CPA, tax, all those things, and you should feel like it's an investment in your business whenever you hire an advisor to do that. So not only that, but the business advice that you get from us, when you're our client, and a lot of times business owners, they get so busy in the business that they don't want to stop and take time to look at their numbers. Well, we make sure that the numbers are in the right place, and we make sure we have a meeting with you every month to review your numbers. So you kind of have an accountability partner there as well to look at your numbers, and then we help you look at it in a way that you can make good decisions, so you can scale and you can increase your revenue, you can increase your profitability. That's what I'm here to do. So
some things that, from our perspective here, we coach over 100 home care agencies right now and growing, and we have hundreds that come to our master classes and other things. And so they hear this quite a bit from us is they need to, as quick as possible, integrate. And the way I look at this is, there's an expense or an investment to those tools and resources. And hopefully they look at it as an investment, because by putting money into scheduling software, accounting software, billing, bookkeeping software, whatever it is, and integrating those together, instead of like stepping over a dollar to save a dime, a dollar that they could pick up. And that dollar that I tell people is not like a real dollar, it's opportunity cost. That's hard to measure. But that dollar shows up really quick. And I see that with a lot of businesses that struggle. They're 3-4 years in and they're still not automating. They're still not integrating and tying things together. And they're doing everything as very manual as possible. So some 3 areas that we talk about quite a bit when it comes to accounting with integration, they're going to have a scheduling software, right? That's one thing we really encourage to get. It's the best way to control the flow of those employees that either add or detract from the cost of services. Right. It's a great way to take care of the revenue flow with the clients to make sure they're taken care of and managed. A lot of those have a billing software tied in. Some integrate with billing software. Either way, those should be communicating or running perfectly. And then you and I talked earlier about the separations of even bookkeeping and payroll, but it's 2024 now. I almost said 2023. We're in the new year now, even. It's 2024. Software technology helps integrate and tie things together. So what ways can home care owners leverage those to ramp up and accelerate that time from opening to being able to leverage a consultant? So what are some things you have to say to tying that integration and pulling that together? Like, what would you have to add to that?
Well, I have a little bit of a disappointing thing to say about integration. But let me tell to start off with, I know we probably don't like to say the names of software, but we all know that QuickBooks Online and Xero Accounting, they're the two big accounting software that's out there right now that people are using. Number one, I would say get off your spreadsheets. Let's get an accounting software that's well known and recognized, and start and integrate. So the number one integration that you can do in that is your bank account to your accounting software. Okay. So you don't have to key in those transactions every time. You integrate it with your banking software, you get it pulled in, and then we can get it classified like it's supposed to be. That's number one thing that you can streamline yourself with, with those things. But what I wanted to say is for right now, we are not recommending that anybody integrate their billing software, their billing / scheduling software with their accounting software. Everybody that we're talking to, that we're pulling on as new clients, it ends up being like their accounting is messed up really bad whenever we get them and they've done that integration, because it's right now it's still double the work to do, because you have to do the same thing in the accounting software that you do in the billing software in order to invoice and cancel invoices and pay invoices. So it's better for us just to keep AR, billing, and scheduling in one and accounting in the other. We will go into your billing / scheduling software and pull the reports we need out of that in order to be able to get your accounting, where it needs to be, and report to you how, the things that we need to report. So that's one recommendation.
So integrate and automate what you can, but then draw those lines separately to ensure the integrity of the books.
Yep,
right?
that's the number one thing right there. Between the billing and the accounting, that keeps our integrity there. But anything else that you can integrate to make your life easier and organize things better, I say go for it.
Awesome, Bill. Hey, really appreciate your time here today. I know this will be available for home care owners to view and watch at various stages of their business and growth. For those that are watching this, we will have some links below this video where you can find Bill if you're looking for some more guidance, some more information on this. There's going to be links to blog posts and articles that he's provided us as well on some of these topics that we scratched the surface of today. We didn't really get into very deep. We had to kind of touch it and go because it's such a big conversation. We've already gone pretty deep here today as it is. Bill, appreciate you a lot for your contribution, your wisdom and knowledge you bring to the home care space. Look forward to hearing more from you soon.
Thanks, Kevin. I appreciate being here. I hope everybody sees the passion that we have for making sure small business are successful. That's what we're here in business to do, to help small business have the best chance at success.
Perfect. Thank you very much.